Happy Wednesday, everybody. This is Twala Lockett-Jones, your purpose-driven realtor. And I just wanted to get on here and just share a little bit of information, some real estate information. So I get a lot of calls from buyers. Well, not a lot, but I do get calls from time to time from buyers, and they're wondering why their mortgage payment increased after they, purchased the home. Several months later, a year later, the mortgage payment increased or, changed. It can go up, it can go down. Typically it goes up, and I'm going to tell you why. So a mortgage payment is made up of your principal and your interest payment for the home. In addition to that, most mortgage companies, they collect money in what's called an escrow account. And that escrow account, it's kind of attached to your mortgage. So when you make your payment, they split out the principal and interest payment, and then you have an escrow payment, and that covers your property taxes and your homeowner's insurance. Okay. So every year when those bills come due, those payments are made by your lender or whoever services your mortgage. They pay those bills for you, so you don't have to think about them. They want to make sure those bills stay paid because they don't want, number one, your home to be foreclosed on for not paying your property taxes. And number two, they want to make sure that if anything happens to that house, that there is homeowners coverage to be able to pay out if there's a claim or a loss, a fire, an earthquake, anything that happens, So the reason that your mortgage payment changes or can change is because in that escrow account, they have been collecting 1/12 of the homeowner's insurance policy and 1/12 of the amount of your property taxes, because there's 12 months in a year. So they collect a 12th every single month. They put it in that escrow account. At the end of every year, they do what's called an escrow analysis. That analysis or an audit of the escrow account will let them know if they are collecting enough in the escrow account to cover those bills that come when the bills come due. If they have not collected enough, they're going to send you a letter and let you know that there is a deficit, meaning that you need to add some money to that escrow account to make sure there's enough money in there when the next round of bills come out. Sometimes there may be an overage. An overage happens if they initially were collecting too much in that first year, or if your property taxes went down, which they rarely ever do, or your homeowner's insurance, if that went down. So you may have an overage. In the case of an overage, they will ask you, do you want us to send you a check, or do you want to apply the overage some kind of way? Like, do you want to apply it to the principal on your mortgage? Do you want to put it in your escrow account? Or they'll have options for how they use that money, because they're not allowed to keep a lot of your money in escrow. There's limits on how much that they can keep in the escrow account, on top of what they need to pay your bills. So as a result of those numbers changing, you may see an increase in your monthly payment. But your principal and interest payments, they do not change if you have a fixed rate interest, fixed interest rate. If you have a fixed rate mortgage, the interest rate does not change. So that payment stays the same all the time. The only part of it that changes is the escrow account, where your property taxes, those can fluctuate from year to year, and your homeowner's insurance. So anywho, that was just a quick little blurb on that. If you got any questions, feel free to reach out to me about property taxes, escrow accounts, anything real estate related. I'd love to help you out. Thank you so much. Have a nice day.